Today marks 3 years since we launched the HSBC Multi Cap Fund. We are deeply grateful for the confidence placed by partners and investors in us throughout this journey. Let's understand more about the category and the product. A multi-cap fund is an open-ended equity mutual fund that invests across market capitalizations. These funds must invest a minimum of 25% of their total assets each in large cap, mid cap and small cap companies. For the remaining 25%, the fund manager has flexibility to invest in any of these market caps. While both invest across market caps, a multi-cap fund must adhere to minimum 25% allocation each to large, mid and small cap stocks. A Flexi cap fund has no such restrictions and can shift allocation entirely to one market cap based on market conditions and at fund manager's discretion, subject to scheme information document, thus offering more flexibility to the fund manager. However, the Flexi cap category has a broad index like the NSE 500 as the benchmark, which may not be ideal, while for multi-cap funds there is the multi-cap benchmark which follows the same diversification norms. At any point in time, the fund would have at least 50% of its AUM invested in mid and small cap stocks. This could drag performance of the portfolio under weak economic conditions and markets. However, in the long term, the diversified nature allows investors to capture long-term growth potential in small and mid-cap stocks while enjoying lower volatility relatively through large caps. Compared to Flexi cap funds, these funds are more disciplined with a minimum investment across all three market cap categories. HSBC Multi Cap Fund aims to attain effective diversification with an actively managed portfolio with minimum allocation of 25% weight each to large, mid and small caps. There is flexibility to invest the remaining 25% based on market conditions and views. The focus of the fund is to identify and invest in strong businesses with sustainable profitability, higher earnings potential and reasonable valuation. The fund adopts a growth at reasonable valuation strategy for portfolio construction. The fund follows predominantly a bottom-up strategy for stock selection with an endeavor to identify scalable businesses which are financially strong, run by competent professionals and at reasonable valuation. Currently, the fund has 47% in large cap stocks, 26% in mid caps and 26% in small caps. It has an active share of about 63%. The portfolio is fairly diversified with the exposure to small caps spread over several stocks. This is largely to reduce the volatility. The top 10 stocks have a weight of only about 27%. While picking stocks, there is a focus on quality of business, strong management, and valuation. Liquidity is another factor that is considered while looking at small cap names. Over the last several quarters, we've seen downgrades to Nifty earnings, which seems to be finally slowing down. The downgrades were possibly due to slower economic growth and headwinds from outside. We feel that most of the headwinds have changed for the better and expect earnings to grow at a compounded rate of about 12% over the next 2 years. The measures taken by the government and the central bank should help improve business prospects and earnings, even if with a lag. Further, the external environment has improved with trade deals getting concluded, which could also boost growth. Sectors of the economy which were laggards till now, including banking, metals, etc., are likely to support earnings growth in financial year 27. With the correction Nifty valuation is now trading close to the long-term average of about 20 times forward. While mid and small cap valuations have also corrected from peak levels, they continue to be at a premium. India's valuation premium relative to emerging markets have now come down to long-term average levels. Foreign portfolio investor positioning in India relative to the emerging markets index is also at an extreme low level. Given these factors, we are more constructive on the markets now. From a positioning perspective, we are overweight industrials with high exposure to power T&D and defense sectors. We are also overweight consumer discretionary and consumer staples sectors. While we are equal weight in financials as a sector, we have high exposure to PSU and mid-tier banks. We are underweight IT, materials, energy, and utility sectors. Portfolio growth rate and valuations are broadly in line with the benchmark index. Broader equity markets, as reflected in the Nifty 500 index, is down merely 5% from the September 24 highs, with large and mid caps less than 5% from the top. However, the small cap index is down about 14% from the high. Even within the small cap index, the breadth is very poor, with more than 60% of stocks down 20% or more from their 52-week highs. With such a correction over an extended period of time, even if at the index level opportunities seem limited, there will be bottom-up ideas, and this is the time to scout for such ideas. Over the last 10 years, the small cap index has outperformed the Nifty despite the last 16-month correction. We believe that this trend will continue in future. Thank you for your continued support and trust in HSBC Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.